Right, good evening. It's Sunday, the 24th of April, and this is the Stage Analysis members weekend video. Gonna go through what's been quite a choppy week. There's been a lot going on, so it's taken a little while to put together the weekend update this weekend, trying to work out the best way to approach it. So I'm gonna go through the regulars. Gonna have go through the index charts, the sectors, industry groups, relative strength tables, some of the features that I did during the week in terms of the market breadth, with the sector breadth and the industry group bell curve chart, and obviously some of the other key market breadth charts, as obviously we're at such a critical point in the market where we could go full stage 4 potentially this week if some of the earnings don't go a certain way. And then to finish off, as obviously with so few potential long side stocks at the moment, actually the weekend watch list is actually an earnings watch list this week instead, as I wanted to focus on those as they're kind of the pivotal stocks for the week. And there's a number of large caps and mega cap stocks reporting in the coming week that basically could tip the market one way or the other. So I think they're key this week to focus in on, as they could be potential long or shorts. So I think that's the best way to approach it. So let's go back to the start here. Actually, I don't want to show this top bar. Get rid of that. So let's begin today with just having a look at where the VIX actually ended the week. You can see there was a massive spike at the end here. We actually broke through this near-term pivot area that we've been in since the start of April here. Mostly it's been choppy above the 200-day moving average for the majority of April, but we had a convincing break to the upside on Friday after a really strong negative day on Thursday as well. So closed out the week on a negative on the VIX, and we're back in very much risk-off environment. As I've said many times before, when we're below this 200-day moving average, it's when it's much more friendly on the long side. So we remain in a choppy environment at the moment in terms of the VIX. If we look at the major indexes, starting with S&P 500, you can see that Thursday and Friday price action there, which was extreme. We had a failure at the 200-day moving average and this prior area of resistance, which I've highlighted for many months now. So you see we couldn't manage to get back through that. It stalled early in the day and then just shot down into the end of the day, then knifing back through the 50-day moving average and then following through on Friday with a large negative day, and lots and lots of actual strong RS groups taking the brunt of the hits on Thursday and Friday. So, but with very little in the way of rotation. I'll go into that in a little bit when we look at the industry groups, but it was a change of behaviour for sure over what we've seen recently, as normally with any kind of pullback days or negative days, we tended to see the in the strong RS groups, we tended to see the weak RS groups pick up and actually get a bounce. But even those areas took a bad hit. But the majority of the selling was actually in the strong RS groups, which have been holding the market up. So if they can't hold the market up, then that begs the question of whether we're going to actually have a major breakdown, even though the vast majority of stocks have already broken down into stage 4, which I'm sure many of you have been aware of for a long time now, especially people that focus on the growth type stocks. They've been in stage 4 for ages now, but obviously the larger mega cap type stocks have been holding up the market, and they've continued to chop around in stage 3, so which the S&P 500 has been the go-to for that in terms of relative strength. So the fact that this is breaking to the downside is a potential point of worry for the entire market, although we are coming towards a potential area that we talked about on last week's video in terms of if we go for the spring type action. So on last week's video, I think we were back around this area. I said we'd be looking for, but one potential scenario is for a spring type move and come back up into here, and that would obviously shake out the weak hands in the market and then start to potentially move us back towards the upside again. So, but obviously the other side of that is you could have a full breakdown. You could just obviously knife down, break back up again, and then continue off down into stage 4 completely. So As I said, many stocks already in stage 4, and we've got a bunch of large caps reporting this week, the likes of Google, Apple, Microsoft, Amazon. I think there's Caterpillar. There's all sorts reporting, but basically they make some of those make up a big percentage of the major indexes. So if their reactions are poor, then we obviously could certainly see a test of the lows that we saw back on the 24th of February and March 14th and January the 24th. So we've had, which are different in the Nasdaq to the S&P 500, as the S&P 500 has shown more relative strength. But in terms of our structural point at the moment, obviously we're potentially either in phase B or we've potentially had a phase C top environment here and then rolling over. So, but if we're still going on the reaccumulation base structure here, then this would still be phase B. But it's, as I said, it's up in the air at the moment. There's no definitive either way. We look at the Nasdaq Composite. It's looking weaker than the S&P 500. As I said, we're testing back towards the lower end of the range where we had this break underneath the 24th of January low back in February the 24th there and on March the 14th. So it looks set to test the lows in that. So in order for it to become a positive, we would need to see it obviously hold this kind of area down here. So we'd want to see a move that didn't undercut much or only undercut a little and came back in with a spring type move and a test and then move back up again, and then for the moving averages to then start turning back up again and start to go on and up that way. But obviously if we do get some negative earnings reactions, we could obviously break fully down into stage 4, and then any kind of, this would then become an area of resistance as we came back in again, and then potentially could be off to the downside on the longer term, which if we look on the weekly chart here, you can see potentially already looks like it's in stage 4 with this. But you see that 24th of January low, we undercut it twice, and this week we actually closed below it, so potentially already in stage 4. But it's a bit borderline because the fact is we still haven't broken this area here of obviously support. So that one's again to be confirmed. Russell 2000 again looking weaker than the S&P 500. You can see compared to the Mansfield zero line here, which is the 52-week moving average of the stock divided by the S&P 500, or the index divided by S&P 500. On the daily chart, we use the 252 day, 253, whatever. That's basically the amount of trading days in a year, which equates to the 52-week chart. So it's a pretty good rough approximation on the daily chart. You don't have to use that. You can, on your daily chart, you can actually use shorter term moving average. A 50-day moving average, for example, can be really useful on individual stocks as well. But I like to look at the daily charts and the weekly charts with obviously the similar settings with the relative strength, so that at a glance I can see where it is instantly and know that that's what it looks like on the weekly chart as well. So again, Russell 2000 here, we've been making this obviously trading range since back on the 24th of January time. Had an up thrust and a test here, and then a last point of supply. So breaking down to the downside in this. So at the moment, this looks like this was phase C action at the top of the range of a redistribution. At the moment, we're in stage 4 on this one at the moment. So it looks set for a test of the low, and whether we obviously break down into stage 4, continuation breakdown in this one or not, it's obviously TBC. If we look at it on the weekly chart, you can see obviously the original stage 3 range and the stage 4 breakdown area here, and then our obviously secondary base that we formed since. So this could obviously potentially go for a continuation breakdown to the downside. As I said, if it can hold here and we can get a rebound, then we'll be looking for this kind of spring type action, and then obviously a move back above the 30-week moving average for it to then hold and move on back up towards the top of the range again. But obviously at the moment we're testing the downside, so our immediate test is whether there is demand at the bottom of the range here. So whether this area can hold or not. If it does, then on your spring type moves, obviously it's one of the initial early entry points in a structure. But the fact that this is a structure within stage 4. It's not an ideal one at the moment. We'd want to see this one particularly recover back above the 30-week moving average, so getting back up into this kind of area first before it became more interesting again, and then waiting for some backing up action in there to find some low risk entry points if obviously it did manage to recover. But at the moment, again, remains in stage 4, so currently it's an avoid. I wanted to show one of the more speculative areas of the market, so similar to the kind of price action we saw in ARK-K and the various other ARK ETFs. IPO is another ETF that basically focuses on, well, as you can imagine, IPO stocks. So it was a really strong performer through 2020, similar to what ARK-K did, and had a very, very similar sort of stage 3 move through 2021, and then before breaking down convincingly into stage 4, so around this kind of area. And you can see we've had a strong stage 4 decline since. It's not been able to hold that base structure there and broken to the downside, so it's obviously still near to the lows in what we call still in stage 4, not quite stage 4B yet, although you could potentially say stage 4B now, considering the amount of time it's been in stage 4. So it's, you could potentially say it's late in stage 4, but it's got a long way to recover in order to get back up to that 30-week moving average, which is still declining. So in order to turn into stage 1, you need this, obviously, 30-week moving average to start to come down, start to roll in, start to move back up again. So you'd be expecting some, obviously, sideways action in this before, obviously, up and out in. So it could be many, many months away if it is in fact making a base structure. But at the moment, continuing to look weak here. So looks set for a test to the downside, at least at the moment. And whether it can hold there or not is to be confirmed. But at the moment, continuing to look weak. Sectors. So we've got the major at the top row here. We've got the gold, 7 to 10 year treasuries, Russell 2000, Nasdaq 100 and the S&P 500, and then the 11 major S&P 500 sectors. So these are a good proxy for the sectors in some ways, but they're not brilliant in other ways. So one of the reasons I do the percentage of stocks above their 30-week moving averages per sector is that it covers a vastly larger amount of stocks per sector than this does. Obviously, these are just focused on the S&P 500 groups, and so healthcare, for example, doesn't look anywhere near as weak as it does in the broader market. If you look at the percentage of stocks above their 30-week moving average in the healthcare group, it's been one of the weakest groups for over the last year, whereas in the S&P 500 version here, it's been reasonably strong. So it gives you quite a different picture at times. Communication services has still been particularly weak. So you got the likes of Facebook and other stocks, internet stocks in that, which have been particularly weak over the last few months or so. But as you can see on here, we had these 2 days on Thursday and Friday where we saw some of that liquidation type selling, where some of the stronger groups like materials and energy really came off, and volume picked up a little bit in those on here. You can see nowhere was really, really safe. The selling was broad-based. So if we look at the individual relative strength table of this, energy still is our strongest group at the moment, but you can see it had a bad week at minus 4.57%. Communication services, which has been the weakest group for a while, had the worst of the weeks overall. So the weakest got even weaker, but we did see these stronger groups start to come off. So if we look through it on the weekly charts here, you can see materials came back into the range again. So we've got potential up thrust and the last point of supply here as it made a lower high. So this is actually a Wyckoff short entry point at the moment, although it hasn't broken that moving average there. So potentially sign of weakness coming there. So if it does follow through from that potential short entry point there, then you'd be looking for a sign of weakness at the bottom of the range, which see bottom of the range is down here. And then for the backup to not go back into the range again, and for that to continue on to the downside. So, but that's materials, communication services, as I said, deep stage 4 decline for many, many months now since breaking down into stage 4 at the start of the year here. So energy, bad week. It's been grinding up higher and been in a strong stage 2 advance. So still the strongest group, but a little bit of a change of behaviour going on there, but not a massive bar on it so far on the S&P 500 version of this. But if you look at some of the individual energy stocks, there was quite a lot of damage done, especially the coal names. They took the brunt of it, which has been the strongest group for quite a while now. So financials also looking a little bit ropey here. We've got potential stage 4 breakdown in progress. We've got industrials also near to potential stage 4 breakdown area. So you've got your range. So this could, if this breaks to the downside here, stronger volume, then you could potentially break down into stage 4. Again, you need to see this kind of action that we saw here, spring type action, in order for it to recover and save. So a sign of demand as such. But you can see that it's had one attempt down already and it couldn't rally. It hasn't been able to muster much, and then it's rolling over again. So again, it's not looking brilliant. Technology potentially testing stage 4 breakdown area here. You can see we've got multiple areas. You've got your head and shoulders type pattern that's been developing on this one. So potentially moving into stage 4. Consumer staples is one of the stronger areas. We had this squat candle here, so some definitely supply coming in there, but it still had a slight up week. Real estate was the strongest on the week, but you can see it's still in this stage 3 structure itself. So at the moment, so failure here and turning around. So if this starts to fall back below the 30-week moving average there, then obviously that one could get negative as well. If it can hold above that 30-week moving average, then obviously looking for this kind of action. Utilities been one of the stronger groups in stage 2, still in stage 2 at the moment. You can see it's in pulling back the last 2 weeks. It was a strong reversal week there last week, minus 2.42%. Not much for most groups, but in utilities, that's quite a big amount. So at the moment, still in stage 2, but a potential buying climax there. Healthcare failed a couple of weeks ago at the top of the range. See that we had a little up thrust and failure and come back in. So if this can't hold this 30-week moving average, if we start to fall back below there, then that potentially could be a sign of weakness there as well. Needs to hold, needs to rebound back towards the top of the range. Again, consumer discretionary, again, looking weak. You can see the failure here twice at the 30-week moving average, and now has fallen back below the 10-week moving average here with a big squat type candle here and reversal on the week. So we got that bottom of your range kind of areas in around this kind of area. So it could potentially make a test for a stage 4 breakdown. And again, you want to look for stronger volume. Doesn't have to have stronger volume on the downside low to make a stage 4 breakdown, but it is in a weak position in stage 3 at the moment. And then back to gold. So gold had a week after the squat at the top of the range here, where it failed to make a new high, and then it's come back in again. We had a big bearish engulfing candle on the week. Lots of individual gold names took it heavily this week. It was another one of the strong RS groups that was particularly hit hard, along with non-ferrous metals, likes of the uranium stocks and the lithium stocks particularly took the brunt of the selling this week, as they've been an area of short-term strength over the last few months. So anywhere that's been strong tended to get whacked in the last few days of this week, as people took profits at any price. Basically, they just got out, closed their positions, and we saw kind of free fall for a couple of days.